Is the worst over, Mike, for the banks?
Well, as I said on your show last time, Tyler, it's short-term earnings hell. So you're looking at weak earnings in the first and maybe the second quarter. The economy is slowing. Over the next 2 years, you might have a doubling or even a tripling in credit costs, 1/3 lower net interest margins, 1/2 decline in earnings, and you have seen some issues with the plumbing of the financial markets. So when it comes to the earnings results of the banks, the worst is not over, and we'll stick to what we said before. It's short term. It's a very, very tricky environment.
Do you like what you're seeing out of the Federal Reserve with specific reference to how it'll affect the banks? Obviously, when you cut rates down to the barest of bones, that hurts their net interest margins, and there may be other things that are hurting, but there may be other things that are helping. What do you say?
Well, there's bigger issues than just the bank net interest margins. And think of this as a three-legged stool. You know, one leg is the banks. And the banks right now, it's night and day from the financial crisis. This is not a banking crisis like last time. Banks are not part of the problem today. Banks are part of the solution, and they have capital, they have liquidity, they have an ability to support the economy. Another leg of the stool would be the Fed and monetary policy and the actions taken by the Fed. They're throwing the kitchen sink at the capital markets. They're hopefully going to improve liquidity. There's some early signs. And the third leg of the stool would be fiscal policy. And if you get this almost $2 trillion fiscal package, you take the banks plus the Fed plus the federal government action all together, I think that's appropriate, and that would be an incredibly strong force. You know, fight fire with fire in this case, and that could really turn things around.
Are there banks in certain sections of the country, regional banks I'm thinking of, that are more vulnerable to what's going on? And I'm thinking specifically of the banks that serve the oil patch, whether it's Texas, Oklahoma, North Dakota, whatever. Are those banks on still on firm footing?
Well, let me say what I said last time, Tyler, on your show. I said short term, you know, anything goes, anything's possible over the next day, week, month. It's just too hard to tell what's going to happen to the banks. Having said that, I am amazed at how far the bank stocks have sold off. They are trading at their average level from the global financial crisis. Crazy. And we have three outcomes for the economy. We have a V-shaped recovery, a U-shaped recovery, and an L-shaped recovery that has a deep recession followed by a Japan-like scenario where you don't grow for years. And right now, the entire industry is pricing the banks as if it's going to be a recession without a recovery. So you really are pricing in a bad scenario. Having said that, you know, we still have kept our sell rating on Comerica. They have more exposure to the oil patch than other banks, and they also have more sensitivity to these lower interest rates. So it's not one size fits all for us.